If you are beginner in the stock market, you must know that the stock market returns are never guaranteed. But yes, when you do the fundamental analysis, technical analysis, deep down the stock or index in the market, you are likely to get some edge in the market, but risk management cannot be ignored. In our last tutorial, we explored fundamental analysis, the study of companies, financial health, valuation, and long-term growth potential. Today, we shift our gears and look at the other powerful approach, technical analysis. So stay with me till the end, because by the time you finish this video, you will know exactly what the technical analysis is, why traders across the world use it, and how you can start applying it to understand the stock market charts. Let's begin. Big picture. What is technical analysis? Imagine you walk into a marketplace. You see prices of apples, oranges, and bananas written on the boards. Over the time, you notice that the prices keep on going up and down based on supply and demand. Technical analysis is exactly the same. The study of price movements and trading volumes to understand what might happen next. In simple terms, technical analysis means studying charts. Instead of reading the balance sheets or income statements, you observe the price and the volume data, usually plotted in the form of charts. The main idea behind technical analysis is the price reflects all available information in the public domain. Market participants, whether they are retail investors or traders, big institutions, or even global events, all get factored into the price. By analyzing the patterns, trends, indicators, you can estimate the probability of future moves. Technical analysis is different from fundamental analysis. Fundamental analysis answers what to buy. Technical analysis answers when to buy, how much to buy, and when to sell. So, technical analysis is not just limited to stocks. Technical analysis is used worldwide in equities, commodities, currencies, and even in the crypto markets. Whether you are looking at gold, Bitcoin, or Apple stock, charts remain the same. The real beauty is that technical analysis works across all time frames. A long-term investor may look at the monthly charts, a swing trader may use daily charts, and day trader may even look at the 5 minutes or 15 minutes charts, all applying the same principles. So technical analysis is nothing but a toolkit. And like any toolkit, its power depends upon how well you learn to use it. In the next segment, let us break it down its core principles. Core principles of technical analysis. Technical analysis rests on three broader principles. Number one, market discounts everything. What does it mean? Market is quite efficient and works under the efficient market hypothesis. This idea comes from Charles S. Dow, the father of modern day technical analysis. It means the current price already reflects everything: company's result, government policies, inflation, interest rate, even future expectations. For example, if a company announces excellent earnings, the stock often moves before the result because insiders and smart money already position themselves. Another principle is price moves in trends. Think of a train on a track. Once it starts in one direction, it tends to keep moving until it slows down. Similarly, markets move in trends: uptrend, downtrend, and sideways market trend. Identifying these trends early is where the technical analysis helps. For example, if the S&P 500 is trending upward, every dip becomes the potential buying opportunity. The third broad principle is history repeats itself. Human psychology drives the market. Fear, greed, hope, panic, these emotions don't change. That's why chart patterns like double tops, head and shoulders, inverse head and shoulder, or flags keep repeating over the decades. What worked in 1980s or 2000s often still works today. Let me give a simple story. Imagine a trader in 1999 looking at a breakout chart of Amazon during a dot-com boom. Fast forward to 2025. Another trader is analyzing Tesla or Nvidia and sees a very similar kind of breakout pattern. Even though the companies, industries, times are different, the psychology behind the price moves remains the same. These three principles: number one, markets discount everything. Number two, price moves and trends. And number three, history repeats are the foundation of technical analysis. Without them, technical analysis would be like sailing without a compass. Now that we know the principles, let us move to the practical tools that bring them alive. Tools and techniques. When beginners hear the word technical analysis, they often imagine dozens of complex indicators, but let me simplify. There are only few basic tools you need to start with. Number one, types of charts. The simplest type of chart is line chart. It connects closing prices of each day. It's very clean and easy, but lacks the details. Next is the bar chart. It shows the open, high, low, and close for each day. A bit more detail, but not very visual. The most popular is candlestick chart. Originating from Japan, each candle shows the open, high, low, and close. A green candle means buyers were in control. A red candle means sellers dominated. In nutshell, candlesticks are language of traders. Another important tool is trend lines. If you connect two or more swing lows in uptrending market, you get a rising trend line called support trend line. Similarly, connecting highs in the downtrending market gives you a resistance line. These act like invisible walls. When the prices reacts them, trend continues, and when the prices breaks out them, it signals a change. Another tool is moving averages. Instead of looking at the raw prices, we smooth them over the time. A 50-day moving average shows the average price of last 50 days. When the price is above the moving average, the trend is strong. When below, it's weak. Traders also use 200-day averages for long-term trends. I use 21 period, 55 period for short-term trend analysis and 144, 200 and 233 period for intermediate and long-term trends. Another important element of technical analysis is volume. Price tells you the direction. Volume tells you the strength. If a stock breaks above the resistance with a high volume, the move is powerful. Without volume, breakouts often fail. Indicators. While there are hundreds of indicators, but two simple ones are worth mentioning. Number one, RSI, Relative Strength Index. This tells you if a stock is overbought or oversold. You can study the momentum, various kind of studies using RSI. MACD is another indicator and a popular indicator. Moving average, convergence, divergence. This helps identify momentum shifts. But here is my advice. As a beginner, don't overload your chart with so many indicators. Start with price, volume, trend lines, and maybe a few moving averages for short term and long term. Master these before moving to advanced indicators. Always remember, technical analysis is not about predicting future with 100% accuracy. It is about stacking probabilities in your favor. Technicals versus fundamentals. Now let us answer a common question. Which one is better, fundamentals or technicals? The truth is, both have their own strengths. Fundamentals tells you what stock to buy based on value. Technicals tell you when to buy based on timing. Imagine you find a fundamentally sound company, fundamentally sound business. It has a low debt, high growth, and good valuation. But if the chart shows the stock is in a strong downtrend, buying immediately may lead to losses or capital gets blocked for a very long time. On the other hand, technical analysis alone may show breakout. But if the company's fundamentals are weak, the rally might fizzle out very quickly. Here is the simple example. In 2020, after COVID market crash, many fundamentally strong US companies like Apple, Microsoft recovered sharply. Fundamentals gave conviction that these were solid businesses, while technical analysis provided entry signal as their charts broke out of consolidation. So the real edge is not choosing one over the other, but combining them wisely. That is what I call it hybrid analysis approach, and that is where we head next. The hybrid approach. Think of a hybrid analysis as a marriage of value and time. Step 1, use fundamental analysis to shortlist good companies, good businesses. Look at the strong earnings, healthy balance sheets, and attractive valuation. Step 2, apply technical analysis to those companies to decide whether to enter or when to exit. Example, suppose you identify Nvidia as a fundamentally solid company. The technical chart shows it is consolidating, and when breaking out above the resistance level with volume, that's your entry. The hybrid approach helps you avoid two common traps. Number 1, buying good stocks at a wrong time. Number 2, getting trapped in a weak stocks just because the chart looked good. By combining both, you tilt probability towards success. That is why most of the professional traders and investors worldwide eventually develop some kind of hybrid approach. Recap and practical advice. So let us recap what we have learned today. Technical analysis is the study of price and volume on charts. It rests on the three broader principles: market discounts everything, price moves in trends, and history repeats. Key tools include candlestick charts, trend lines, moving averages, volume, and simple indicators. Fundamentals tell you what to buy. Technicals tells you when to buy. The hybrid approach combines both for maximum edge. But remember, technical analysis is not a magic formula. It is about improving the probability, not predicting the certainty. Here are my two final pieces of advice. Practice on charts every day. Even half an hour practice daily can build your eye for the patterns. Keep it simple. Master the basics before chasing the advanced tools. Trading and investing are lifelong learning journeys. It is not a destination. And I always say, learning never stops with DK Sinha.